All right, hi folks, welcome back. Today is day 4 of our SIE review, and our section today is right. Remember, last week we covered municipal bonds, municipal securities. Those are bonds that are issued by state and local governments. So today, in our next part, we're going to go over money market securities. Now, when companies or governments, when they need their long-term financing, they go to the capital markets. But when they need short-term financing, they go to the money markets. So money market securities are debts. They're debt means they're bonds, but they're short-term bonds. And when I say short-term, that means they come due, they mature in 1 year or less. And it's often less. In fact, often even a lot less. But the definition is 1 year or less, but also have a very high credit rating. I must have a high credit rating. So, in fact, as a money market security. So, because of this, because they have a short term until maturity and have a very high credit rating, they're considered very, very safe and very stable. In fact, money market securities are considered to be cash equivalents. Cash equivalents. Okay, so that means they're considered as safe and stable as cash. That's why you can write checks from a money market account. Okay, all right. Why a money market fund, right, which invests in money market securities, maintains a stable value of $1 per share and doesn't fluctuate up or down. So one share equal $1. Okay. Oh, question is, can we do practice problems like this in the beginning of class? Yeah, I'd like to do that. Okay. And since we're a little ahead of schedule, all right, we've got the time to do so. Okay, so what type of instruments become money market securities? Well, first off, what do we know that comes due in less than a year and has a very high credit rating? How about a treasury bill, right? T-bills, right? They mature at 52 weeks at the most, and they're government guaranteed. So that's as safe gets. So a treasury bill would be an ideal money market security. But you know what else would be? Also would be like a 30-year treasury bond issued 29 years ago. Right? Because it has less than a year to go until it comes due, it would also be considered a money market instrument. A commercial paper, this is short-term financing for corporations when they need their short-term financing, usually for inventory, right? Self-liquidating inventory. They'll buy a bunch of raw goods, put them together, and sell them as inventory, right? And then use that the proceeds from the sale to pay off the loan, right? So commercial paper is for short-term corporate financing. The definition of commercial paper is maximum 270 days to maturity, 270 days or less. Now, 270 days is about 9 months, but it's more accurate to say 270 days. In fact, I once saw a practice question that said it was commercial paper that matured in 280 days. 280 is not 270. That would not meet the definition. But also to meet the definition, okay, would also have to have, okay, minimum $50,000 face value and have a top 3 credit rating from a nationally recognized ratings institution. Now, those would be like Moody's or Standard & Poor's. So since they get they have high credit, a good credit rating, right, and no more than 9 months, no more than 270 days is considered commercial paper and is exempt from registration with the SEC. Bankers' acceptances also. Now, when you see a banker's acceptance, think of import-export. Okay? So they're used to finance import-export. So what happens? So okay, so if you're dealing with foreign trade, import-export, well, companies usually often buy on credit, right? So, but since they're from different countries, they don't know each other, so they don't have any credit with each other. So a bank steps in, so they go to a bank and say the bank will guarantee payment. Now, this other company, this foreign company, well, they already know about Bank of America or Chase or Wells Fargo, so they'll take their word for it. So the bank will accept it, and these bankers' acceptances are now short-term bonds using to facilitate import-export or foreign trade. And of course, they can be bought and sold too, right? They're tradable instruments. Also, no more than 270 days until maturity and bank guaranteed. Also considered very safe. Another one are negotiable CDs. Negotiable means tradable, right? That means there's a marketplace, there's a secondary market. They can be bought and sold between investors. Normal CDs, no, they're not negotiable. They're redeemable. Your regular CD, it only comes due at the bank, okay? And there may be a substantial penalty for early withdrawals. But the jumbo CDs, $100,000 plus, those have a market for them and they can be negotiable CDs. All right. Now, if they're up to 250,000, they also have FDIC coverage, right? If they're held in the customer's name. But as jumbo CDs, they can be bought and sold. Okay. And if they're longer than a year, they can also be, make regular semi-annual interest payments. Okay. Yes, Hannah, I see your virtual hand is up.
Is a jumbo CD the only bond or stock that has FDIC insurance? I thought FDIC was only for deposits.
It is, but it is a certificate of deposit, right?
Oh, yeah.
It's just that they can be bought, they're tradable, so they can be bought and sold. But
Okay.
other than that, they're the only thing that would have FDIC coverage.
Okay, thank you.
Sure thing. Okay. All right. Then there's also what are called repurchase agreements and reverse repurchase agreements, and these are basically between the Federal Reserve and the dealers in government securities and with banks. So as a repurchase agreement, it basically means I'm going to sell a bond to you, I'm going to sell something to you, and I promise to buy it back from you at an ever so slightly higher price. That's why they call it a repurchase agreement. And some of them can literally be overnight repurchase agreements, which literally last one day. Now, when we get to economics, we'll see this more frequently. But the Federal Reserve can basically buy securities or buy treasury bonds from banks and promise to sell it to basically sell it back to them within the next day. Now, by doing so, if the Fed is buying bonds from banks, now the bank has more cash. Since the bank has more cash, it has more money available to lend out to businesses, right? And since the bank has more cash, this causes their cost of money, their supply of money to increase, and the cost of money, which is interest rates, to go down. Now, on the other hand, reverse repurchase agreements, that's the opposite. This is where the Federal Reserve um, uh, sells treasury bonds to banks and then will buy them back later at a slightly higher price. Okay, and I mean really slightly higher, very just like razor thin margins, but they move a lot of volume. Now, when the Federal Reserve sells treasury bonds to banks, the bank pays out money to buy these bonds, and therefore the bank has less cash available to lend out to businesses, which causes their supply of cash to decrease and therefore cause the price of money, the cost of money to go up, interest rates to go up. Now, euro dollars. Now, the term of a euro dollar is is a currency, is U.S. currency that's actually held outside the United States. Okay, so and a euro dollar bond is a bond that's issued outside the United States by a foreign country or maybe a foreign government sometimes, right? But it's denominated in U.S. dollars and makes interest and principal payments in U.S. dollars. This prefix euro is just a term that means of a currency that's issued outside of its home currency. So, okay, so a euro dollar bond is a bond that's issued outside the U.S., denominated in U.S. dollars. Since it's issued outside the United States, it's not available for trading, and it won't be registered with the SEC. It can be available, by the way, after a certain period of time, after a certain seasoning period. Okay. Now, because it's denominated in U.S. dollars, it pays interest and principal in US dollars. Now, for a US investor who buys it, there's no currency risk. They're going to get paid in US dollars. But for foreign investors who might buy euro dollar bonds, there could be a currency risk because they'll have to convert US dollars into their own home currency. Now, the interest rate that it pays, okay, is going to be determined by what the new interest rate is called the SOFR, called the Secured Overnight Refinancing Rate. It replaces the one called LIBOR, which stands for London Interbank Offered Rate. So this was done as the international exchange rates. So what used to be LIBOR is now called SOFR. Okay. All right, longer term CDs. Okay, longer term, that means they last more than a year and they're issued by brokerage firm, not banks. So they call them brokered CDs. So basically, what happens is a broker dealer firm basically buys a big block of CDs from a bank. And then they take these CDs that they bought and break them up into smaller pieces and resell them to their customers. Okay, so that's what they call a brokered CD. Now, because it's a brokered CD and not actually coming from a bank, customers do have to know that the one they bought is subject to market prices fluctuations. Now, they do tend to still be very stable, but there can be some price fluctuation. Selling it for maturity can be less than the purchase price, and they have a limited secondary market. In other words, there's not a lot of trading for these brokered CDs. First off, people who have them tend to be buy and hold, so they don't tend to buy and sell them anymore. Also know that they may be callable, and therefore they could be called away from investors, right? Could be cashed out prematurely, right? You remember what a callable bond is? Reinvestment risk, which is the risk that when it makes semi-annual coupon payments or interest payments, well, unless someone's going to spend that money, they're going to put it back to work. And if interest rates have gone down since that CD was issued, they won't get the same rate of return as they did before. Right. CDs are called step up or step down, which means if it's called that, which means it has, instead of a fixed locked in interest rate, it has a floating interest rate. The interest rate changes based on market conditions. Maybe they'll tie it to something like what a treasury bill is doing, for example. So this also, again, that the initial CD rate may change and may not reflect current market interest rates or reflect the yield to maturity. Because if you don't know exactly what it's going to pay until it matures, is you're going to have a hard time calculating a yield to maturity. So you kind of have to make sometimes some assumptions. Is the CD FDIC insured? If it's held in the customer's name, it is. But if it's held in the broker-dealer's name, it is not. Now, by the way, I've got some CDs from my broker-dealer firm. I use basically some short-term CDs. And I think that they're in the broker-dealer's name and therefore not FDIC insured. Not that I've been worried about that, but okay. A question here is, was it a recent change from LIBOR to SOFR? Yes, it was. I'm not exactly sure when that happened. I think it has been quite recently, though, like within 1 or 2 years. And I think that's because, again, this is not a testable topic, so don't worry about it. But I think there was some controversy about maybe some price fixing in the LIBOR rate. Okay, like I said, don't worry about that for the test. Just all you got to know is, okay, is how it reflect the current rates. Okay, you're using SOFR now. All right, sure thing, Amy. Okay. Anyway, that's really what we have covered about money market securities. So that's really about it. Let me see if there's, the next thing is here. Yeah, the next thing is about packaged products. So we're kind of a little bit ahead of schedule in that sense. Okay. All right. Is there anything else we need to cover? We need to go over? Is there anything about municipal bonds since we talked about it on Monday? I want to make sure that you've got what you need here on municipal bonds. So I'm just going to step backwards a little bit here to see. Okay. General obligation bonds versus revenue bonds. Those are the two main categories. In fact, let me ask you this question. Okay. Let's say the city government wants to build a high school gymnasium. From what you know, is that more likely to be issued covered by a general obligation bond or a revenue bond? What do you think? Okay, so back to 1014. Okay, let's see. So someone says, okay, we have a choice for revenue, another for a GO bond. Okay, another for revenue. Okay, it would be a municipal bond, yes, but more specifically, would it be a general obligation bond or a revenue bond? Yes, Jason.
Oh, that'd be general obligation.
Okay, so general obligation. Okay. All right. Anyone else got a thought about that? Would you like to? Okay. 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 General obligation bonds or revenue bonds. Okay. If remember the difference is where does the money come from that is used to repay the interest and principal on these bonds? General obligation bond, like the name suggests, right? Everyone's responsibility because it is. Those bonds are paid by taxes. Revenue bonds, however, are paid by the revenue the project generates. Now, do high school gymnasiums are they known for generating revenue? Do they have user fees? No, they don't really have user fees, do they? Okay. No. So a high school gymnasium much more likely to be financed by a general obligation bond. Yes. What if I said the city is considering they want to do an expansion to an airport, like Phoenix Sky Harbor, right? They're going to build terminal number 5. Is that more likely, you think, to be financed by a general obligation bond or a revenue bond? Hmm? Okay, got a few people answered here, but can you tell me anyone else? Right. Well, so far everyone who's answered suggests a revenue bond. I think I agree with you because, right, do airports generate revenue? Well, people fly in and out there and they buy tickets and they might have some tax on top of those tickets and they might charge something for those airplanes to land their airplanes there. So yes, much more likely, I think, to be a revenue bond. What about a public golf course? Okay, they want to build a public golf course. What do you think? Revenue or general obligation? Okay, all right. Okay, got a couple of got some people saying revenue, some people saying general obligation. Okay, all right. A little mixed opinion on this one. Okay, okay, right. A municipal golf course, yes. Okay. Well, here's a question for you: do golf courses generate revenue? Yeah, do they charge? Right, they charge some green fees, right, for people to come and play golf. So I think that's more likely to be financed by a revenue bond. The course is at cost. I'm not sure, but if it's public, right, it means everybody can come in and play golf, but they'll still charge them, right? You have to, they'll pay some sort of green fees to play golf there. Is it public as in paid by property tax? Well, I'll say public as in it's open to the general public. It's not like a country club. Okay. The cart, the clubs, the holes are at cost. Well, who knows, right? But do they? Okay, but is it a revenue generating project? Well, if it's a revenue generating project, it's more likely to be financed by a revenue bond. Okay, what if it's city owned? Even still, right? If it's city owned, right, it's still available for the public to play golf there. But to play golf there, you have to pay some fees. Okay, so yeah, revenue bond. Yeah, okay. If you want to rent a golf cart, right? There's some more fees, right? Okay. All right. So anyway, I hope you have the thoughts here. Um, Karina, I'm suggesting that you may have a little skepticism or something. Can you tell me?
Yeah, it's just a little confusing because it just sounds like the public kind of threw me off. Like it's as if it's like open to the public, like there's no fees, like it's part of the
Oh,
um I don't know, part of the
mhm.
the I don't know, part of the package.
Okay. Well, look, anything's possible, right? Anything's certainly possible. So if it is just open and anyone can play for free, well then it's not generating revenue, right? Okay. So that would have to be paid by a general obligation bond. But I think usually you have to pay something to play golf. A public parking structure. Well, if you can park for free, that would be a general obligation bond. But if you have to pay to park, that would be a revenue bond. Okay. All right. Good. It makes sense. Okay. All right. So I hope to get the idea here um, about bonds. So actually, before we go on, okay. Yes. Yes, Hannah.
So I understand the difference of the general and the revenue about if it earns income, but if you're actually an investor choosing to invest, is there any difference really for you?
Well, there can be because as an investor, general obligation bonds are considered generally very safe because if necessary, right, that municipality can exercise its taxing authority, right, and to whatever tax they have the authority to levy to ensure that the bonds don't go into default. But if it's a revenue bond and it's dependent on those user fees, and maybe after, maybe they have to pay for like maintenance and operations first, well, there's maybe that possibility the revenue is not going to be enough to cover the cost and still pay interest and dividends. So the default risk of a revenue bond is a bit higher than it is for a general obligation bond. Now, overall, they're still considered very safe, but there's always that possibility. So for an investor, if safety is their bigger concern, they probably want to go general obligation rather than revenue. Okay, sure thing, Hannah. All right, Okay, hang on a second. I want to do a pause here on the recording.